Thank you very much for joining us. The following presentation is from a webinar titled Professional Ethics, originally produced on April 18th, 2013. The presenters are Michael Hoffner and Elaine Nissley with McKonly Asbury. Enjoy the presentation and visit us online at www.macpas.com for future events and webinars.
Thanks, Reed, and welcome to all of you who are joining us today. By way of introduction, my name is Mike Hoffner. I'm a partner with the firm. I've been with McKonly Asbury for about 8 years now, and my responsibilities at the firm involve overseeing our assurance and advisory practice, as well as having responsibilities for our quality control function and our independence and ethics matters.
Good afternoon, everyone. My name is Elaine Nissley. I've been with McKonly Asbury for about 8 years. I lead up their internal audit outsourcing and risk management services area, where I get involved in a lot of governance reviews and have a lot of fun interviewing people in various organizations. So I look forward to working with you today, and we're going to turn it over to Mike.
Thanks, Elaine. By way of agenda today, we're going to be spending a little bit of our time talking about the governing standards for CPAs. All of you who are credentialed as a certified public accountant are required in Pennsylvania now to have ethics credits. So we'll help you achieve those credits today by talking about some of the rules that surround our profession, both from the American Institute of Certified Public Accountants and the Pennsylvania Institute, as well as a few other rulemaking bodies. We'll end our presentation then with some conversation from Elaine relative to the standards surrounding internal audit and some of the credentialing there with the rules that are promulgated by the Institute of Internal Auditors, as well as ISACA, the Information Systems Audit and Control Association. There are multiple ways to present and talk about ethics and integrity in accounting. There's the simple way of talking about examples and giving illustrations, and then there's just talking about the dry and detailed rules that we all have to follow. Unfortunately, we're going to spend most of today talking about the rules, but there are examples we'll go through in time. One of them, of course, being the old adage, a good accountant can tell you that 2 + 2 = 4. A really good accountant can make 2 and 2 equal whatever you need it to be. So the next few minutes of our presentation are going to sound very much like being back in the classroom. We're going to talk about the rulemaking bodies. We're going to go through a number of the rules that we have to follow and talk about each of the things that are considered by the American Institute relative to the things that we're held accountable for as certified public accountants. We're going to talk in most detail during this presentation about the AICPA's rules, which are referred to as the Code of Professional Conduct. But we will spend a few minutes talking about state rulemaking bodies. We'll talk about the U.S. Government Accountability Office, the Department of Labor, the PCAOB, and the SEC, among other organizations. Those entities have specific rules relative to ethics and independence that we need to follow, but most of those really do parallel the AICPA's rules, so we'll spend most of our time on that area. The AICPA's Code of Professional Conduct is available to anybody who wants to take a look at it. The full text of the document is available at the AICPA's website, aicpa.org. Very easy to find through a Google search. And in fact, if you have a desire to, you can go back and read the Code of Conduct in all of its iterations over the last decade, as they do release a new version of it each and every year. The way the Code of Professional Conduct is structured is fairly straightforward. The first section, which is actually Section 50, is referred to as the principles. Those are the overriding framework for the rules. Those are the concepts that we have to follow in thinking through independence and ethics matters, thinking through how we conduct our business and serve our clients. And then the second portion of what you'll see there is referred to as the rules. These are specific sections with very, very specific criteria and examples that have to be followed by the accountants in conducting our business. The Code of Professional Conduct is broken down into 6 articles, which in very general terms dictate the overall rules that we're supposed to follow. You can read a lot of detail if you go to the full code itself as to what each of these articles say, but I'll spend a few minutes summarizing what each section refers to. Article 1 is simply referred to as the responsibilities of the CPA. In very simple terms, it states that the CPA's responsibility is to those who use their services and to the general public. The key there being the word and. Our services or our responsibility is not just to those who use our services, but more importantly, it's to those who use our services and to the general public that may rely on those financial statements. And that's something that gets very important as we get into the rules a little bit later as to how those rules dictate not just thinking about the client the CPA is serving, but also about the public relying on what those numbers say. The second section, Article 2, is relative to the public interest and simply clarifies that the distinguishing mark of our profession is the acceptance of our responsibility to that public interest. I like the term and the phrase that's used in the article itself, and I'll read that to you. It's defined as the collective well-being of the community of people and institutions that the profession serves. So again, the focus really being on the fact that the CPA's job is to serve the public and serve the public markets, not just to do what's in the best interest of the client itself. Article 3 is focused on integrity and at a very high level states that service and public trust should not be subordinated to personal gain. And many of you may have seen the recent article and publications relative to some insider trading that again has been put out in the public news. A partner at a major accounting firm has been accused of some inappropriate behavior in giving some inside information to a friend who invested in the stock of more than one company that they shouldn't have had that information for. So we think very simply, if we're in this business, we're people of high integrity. If you've gone through the process of getting your degree and getting your CPA license and you sit back and focus on why I do this and what I do, we do it for the best interest of the public good. But time and time again, we're reminded that there's examples of people who need the reminder and who need the training and focus that we really need to do this for the best interest and the benefit of others, not for ourselves. And that's what this section's focused on. Section 4, Objectivity and Independence, really specifies very clearly that anybody in practice or anybody with the CPA designation needs to be free of conflicts of interest. And the way that they define that is not just conflicts of interest in fact, but also in appearance. And it's important to consider that appearance part because the focus there is if somebody looks at it from an outside perspective, and somebody thinks that you're crossing a line that they don't think a CPA should cross, whether the technical definition of independence says you've crossed that line, the rules and the principles here say that you probably have crossed that line and done something that you really ought to consider twice. That section goes on to talk a little bit about objectivity and clarifies that objectivity is a state of mind, it's an obligation to be impartial, it's to be intellectually honest, and to be free of conflicts. So again, we talk a lot about principles here, and these are very ethereal, high-reaching, far-reaching things, but it's really what our obligations are grounded in and what ethical foundations and principles are grounded in. Article 5, Due Care, uses some words that I find very interesting when we talk about the Code of Professional Ethics, and it's a phrase that you don't expect to hear when you read literature published by the AICPA, but it basically says this. It says, a member should observe technical and ethical standards, strive to improve competence, and this is my favorite part, they should apply a quest for excellence. And the quest for excellence is that phrase that you don't expect to see here, but when you think about it, it really sets a very high bar. When you talk about due care and how we approach our job, how we approach client service, how we approach serving the public markets, that quest for excellence says two things. It says, one, the standard is incredibly high. Excellence has a very clear definition. It's a high bar to strive for. But the other thing it says is that it's a quest, it's a journey. It's not something that we can ever say we've achieved, but we're constantly striving to get there, and that's really what this area is focused on. The final article in the principles contained in the Code of Professional Conduct is referred to as the scope and nature of services. And simply said, it means a CPA in public practice has to ensure that they don't create a conflict of interest and that they have good quality control procedures to ensure that the services they do perform are both competently delivered and adequately supervised. So all of the things that we've talked about that are contained in the Code of Professional Conduct principles are really things that are kind of obvious. We talk about the responsibility to the public interest. We talk about the need for integrity and objectivity. We talk about the need to have an objective state of mind when we do our work. And finally, this last one, as we said, it's really obvious. The fact that services need to be competently delivered and adequately supervised. So as you go back and look at the Code of Professional Conduct and you look at the articles and we start to talk in just a minute about the rules, you'll see how these are just general principles and each one of them are going to guide a section of the rules as we get into more of the meat on the bones of what we're going to talk about. So as we move away from the principles and into the rules section, I just wanted to point out that there is a chat function in your window. If you have any questions on the things that we've talked about at a very high level thus far, or as we continue on, you can pose that question through the chat function, and we will have some time a little bit later in today's presentation where we'll address those questions and we'll answer those questions. So moving on into the rules, Section 101 relative specifically to independence covers all of the general rules on attest services. Attest services being the things we think of where a accountant issues an opinion, whether it be an audit or a review, a compilation report, an agreed upon procedures. So really there's things that require a certain level of independence underneath the rules that we're going to talk about here shortly. When you think back to the late 90s and the early 2000s, we didn't have a lot of clarity on what some of these interpretations meant. That clarity came as a result of a lot of the frauds that all of you will remember, the Enrons of the world, the Health Souths of the world. As we go through those and think about some of the guiding principles relative to how those audit firms behaved, a lot of the principles were in place, but there wasn't a tremendous amount of clarity on the rules. Rules relative to the way we need to behave for independence, the way we need to behave and how we interact with our clients. That's really what these rules are getting at. So a lot of specific clarity is contained in the documentation now, and it's things that we're not going to go into in tremendous detail today, but I do invite you, if you want some great bedtime reading or something to help you fall asleep at night, to go ahead and download that document and give it a good read. And that detail that I referred to does have a lot of definitions relative to what kinds of family members may impair your independence, whether your cousin's, uncle's, sister's investment in a particular stock of a company that you audit might be an issue to be concerned about, things that really go beyond the scope of what we're going to spend our time on here today. But if there are any questions, certainly the detail is there, and they've gone to great length in the AICPA document, as well as some frequently asked questions documents to make sure they answer those unusual and unique circumstances that we may from time to time face. Rule 102, specific to the integrity and objectivity, speaks specifically to conflict of interest, making knowing misrepresentations, and gets into a little bit of detail on when you have a conflict with certain advisory services you may want to perform when you're also performing attest services. So some of the examples that are contained in the literature. For instance, if a CPA who's provided personal financial planning and tax compliance services for a married couple who may be undergoing a divorce, and each party in that divorce asks that CPA to come in and be part of their process and be on their side, per se. Clearly, there's a conflict of interest there, and the guidance has given a little bit of discussion on how you would handle that conflict of interest. Another example, a CPA has a significant financial interest or maybe is in a position of influence on an advisory board of a company that happens to be a major competitor of a new client for the firm, and that person is involved in the audit of that major competitor. So obviously a conflict of interest, and there's some dialogue and discussion on how to identify those and how potentially to unwind those. Lots of examples included there. Most of them are aimed at the individual in public practice. But there's some discussion if you think about being in private practice, and quite frankly, if you're joining us here today to get your ethics credit, but you're not in public practice, all of this, while it may not sound as applicable, it is applicable, and you need to be thinking about some of the questions that your company's external accountant does ask you, and some of the knowing potential misrepresentations that could be made that might cross that fine line into getting the right answer or the wrong answer. Back to the earlier slide, I need 2 + 2 to equal 5. There's a lot of gray in the literature, so I'm going to state a case or make an argument. The literature does guide that as well, and it does govern that. Even though it's focused on certified public accountants in public practice, there are certainly a significant number of CPAs who are not in public practice and working on the industry and private side, but you need to be familiar with these rules on a regular basis. Section 200 is focused on 3 specific areas. It's rules surrounding the general standards with how a CPA would go about their business. relative to competence, due professional care, how we plan and supervise engagements, how we determine whether we've received sufficient relevant data to conclude on an accounting or an audit area or an audit matter. Rule 202 is about compliance with standards. How do we ensure that we're complying with the technical standards that those financial statements are supposed to be accounted for and compliance with? And Rule 203 is specific to the accounting principles. Clarifies what the CPA's responsibilities in providing an opinion on financial statements should be. This is an area that's in particular of importance to those who are in the corporate side, the client side of our world. Rule 203 may speak to the CPA's responsibilities regarding providing an opinion. But really, when you get at the root of it, it's not just about the external accountant. It's about the representation letter that's signed by management. It's about the trial balance that's provided with known misrepresentations or errors. It's things that really do tie back to the corporate side of accounting and not just the external auditor's view on things that are spoken to in this Section 203. So again, an area that it's not just for those of us in public practice, but something that those in private industry really should be cognizant of and aware of as well. Section 300 of the Code is focused on a couple different areas, the first being confidential client information. This is that common question we have relative to services that are provided by an auditor or a tax accountant, somebody in public practice who is working in a client, let's say in a sensitive industry, somebody who has a lot of private information relative to healthcare data, Social Security numbers certainly being an easy example. And our rulemaking body is very specific relative to the confidentiality of the information that we as CPAs touch on a regular basis. There's a prohibition, it's very specific, about disclosing confidential client information. And time again, if you were to dig into some of the releases on ethical violations, many of those are related to inadvertent or knowing release of confidential information or discussion of confidential information without the client's consent to do so. These can be as simple as you're at a ball game having a conversation with the person next to you who is part of an engagement team, who may know everything specific about the client you're discussing, and yet there's somebody over your shoulder who can be hearing the things you're saying. So it goes beyond just focusing on, let's say, the trust information that your client has provided you or the specific documentation you've been given. It really goes to the conversations we have, the things that we need to be aware of and cognizant of when we're out in the marketplace. It does not relieve us in public accounting of the requirement to respond to a subpoena or a summons, but there are some specific discussions relative to our responsibilities if we get a subpoena or if we get a summons to provide certain documentation. So if you have any curiosity or interest in that, feel free to read the details, but we aren't going to go into those today. Rule 302 is specific to contingent fees and situations when an accountant can or cannot be under a contingent fee arrangement. So, for example, an engagement where, let's use a simple example like a SG&A reduction study. If an accountant wants to come into an organization and do a study on some of the cost structure of that organization, there are two different ways you can do a fee structure. The first way would be a very specific time and materials fee, so it's going to take me X number of hours and my rate's X dollars per hour, so I will charge whatever that might cost. The second way is the contingent fee model, where if I find you $100,000, I get $30,000 of that savings. If I find you more, obviously I get more. If I find you less or nothing, I get less or nothing. The contingent fee model in that description is allowable for a non-attest client. It is absolutely under these rules prohibited for a client that accountant might do an audit, compilation, or review function for. And there's some other tax areas that are also under that prohibited area. So you just need to be very cognizant from the outside, if you're on the public accounting side, need to be very aware of what services the firm might do for a particular client. And if those services are audit or attest in nature, then the contingent fee model is not prohibited and has to be avoided. If there are no attest function or attest services that client served with, then the contingent fee model is certainly acceptable and a way that all parties can win, and we're all incented to find more savings and a better way to do things. Section 400 of the Code of Professional Conduct rules is relatively simple, considering that it says nothing at this point. It's an area that's been reserved for future use. It's entitled Responsibilities to Colleagues, and you all may read into that however you wish. I choose to read into it that they just haven't done anything there yet, not that they desire for us not to actually have any responsibilities to our colleagues. So we'll move on to Section 500. Section 500 focuses on a couple of unique areas and very specific areas. The first is relative to acts discreditable to the profession. That gets into things like negligence in the work we do. These are areas that a CPA can very, very quickly lose their license, be suspended or revoked if we get into an area of negligence. Poor employment practices. So if there's proven that an accountant or an accounting firm violates employment law on a regular basis and knowingly, that's an act discreditable to our profession. There's a lot of general ethics matters contained in there, some false or misleading marketing discussions. So it's okay to say we're a really good firm. It's not okay to say that for XYZ firm is the only firm which can possibly get you the right answer on a certain matter, because that might be misleading. So there's really a hodgepodge of miscellaneous items contained in Rule 501. Rule 502 is specific to advertising. Again, a little bit more discussion and clarity on the false, misleading, or deceptive advertising, as well as some discussion on the use of coercion, harassing conduct in marketing and advertising. Now, I personally struggle to find ways that a accountant could harass somebody into using them through advertising, but apparently it's happened, and so therefore Rule 502 exists in part to make sure that we don't continue to go down that wonderful path. Rule 503 gets back into the discussion on commissions and more specifically referral fees, and when it's acceptable and appropriate for a CPA to accept a referral fee for sending another service provider to its client. And so there's some specific nuances and discussions there just to be aware of and cognizant of, and to make sure that if you're entering into a referral arrangement for a client that you provide a test services for, you just need to be real careful on how that's structured. And then finally, Rule 505 gets into a little bit of specifics about the form of the organization and the name of the firm and how you can and can't set up an accounting firm. And a lot of those rules get more specific at each state level. The AICPA, the national level, is a little bit broader, and then each state may get into its own nuances under that particular topic. So as we talked about a little bit ago, Rule 101 gets into some real specific discussion on independence and focuses on the integrity and objectivity component and some of the rules surrounding that. To give a little bit more detail and discussion on this somewhat key area, and an area that quite frankly is often misinterpreted in some areas, often there are a lot of questions surrounding some of those nuances, as I mentioned earlier, relative to a family relationship and how that might impact someone's independence. So to overcome some of those unknowns, the AICPA publishes and maintains the Plain English Guide to Independence. So this is a document that the AICPA maintains and updates regularly and often has very small nuances that are changed as more questions are asked, but it's publicly available and something that really gives a lot of clarity on some of those questions that we might ask. It talks about what we mean by independence in appearance and how to go through some of those assessments in your mind. Some of the definitions and illustrations that really help work through questions we have when we're deciding whether we can do a particular service or not. So it's an area that takes what is rather complex in the rules, and I'll say it's kind of a independence rules for dummies under the AICPA rules. So it's a very well-titled document, the Plain English Guide to Independence, and actually is one of the more helpful things in this area that you can use to try and figure out what the right course of action in any scenario is. Some of the matters contained in the Plain English Guide to Independence are contained on the slide that's in front of you now. There's a lot of discussion on when you can accept a board position with an audit client, or if you're on the internal side, if you're a CFO, CEO, a controller, when you might be able to offer or discuss offering your accountant a particular position in a board or advisory role. There's discussion on the difference between a network and an association firm. That's something we won't get into a lot of detail on today, but if you are on the public accounting side of things and your firm is a member of either a network or an association, that's an area you probably should understand and understand some of the consequences of being part of a network versus some of the independence of being part of an association. I already talked a little bit about when family members are subject to the rules. That's a very frequent question and an area where there's a lot of gray, I'll say, and so there's some discussion and dialogue in that area. If you happen to work as a CPA with financial institutions, you may ask that question, can I take a car loan from the bank that I work on? Can I take a home loan or a mortgage? Can I take an unsecured line of credit? Each of those things are addressed and answered because the AICPA really wants us to have clarity on those matters and not have it be our interpretation versus somebody else's interpretation and have a disparity in practice across the board. And then finally, gifts and entertainment. The idea of entertaining a client from a CPA's perspective or a client taking a CPA out to dinner or to a ball game. These are things that happen every day, and the AICPA's goal simply here was to give some level of threshold to when you might consider that to be an impairment of the objectivity of the accountant, or if you get a little more simple in your language, when are you just getting too close to your accountant and that relationship becomes blurred from independent external advisor to something more of a too colloquial relationship, if you will. There are just two areas that I wanted to specifically address relative to some of those items I just spoke on. The first is service on an advisory board or as an honorary director or trustee. For those in public practice, frequently we are asked to serve on advisory boards or to be an honorary trustee. And in many of those cases, it's for a client that we may do prohibited services from. It may be that the individual doesn't work on a particular client, however, the firm serves that client, and so therefore the rules may prohibit that individual from providing a service that would impair the independence. So the AICPA put out some clarity relative to when we can serve in those roles and when we can't. And quite simply, it's got to be very specific as to function, and it has to be a non-voting role. So when you focus on the word advisory board versus board of directors, it's perfectly acceptable for a CPA to sit on an advisory board and give some direction and ideas as long as they are not the final decision maker in that organization. So it does free the accountant a little bit to participate in board service and serve the public markets in that way. The second area is on some of the non-attest services and making decisions on what's accepted and what's not. And actually in the Plain English Guide, there's some pretty specific discussion on that particular area. What it gets at is when can the auditor also come in and help the client perhaps process transactions or close the books. And to dumb down the rules and very simply state it, the auditor can perform those services as long as somebody at the client is taking complete authority and responsibility for what is done. So if certain reconciliations need to be done and the company is, let's say, a few months behind because of turnover, the accounting firm is permitted to come in and help with those reconciliations, but only if there is a responsible management level individual who is at the company who can take final oversight on those reconciliations, book the adjustments that might come out of those, and give the oversight and approval for what's done by the accountant. So often we think very much in black and white terms, and we say, I absolutely can't go in and help my client in certain roles, but many of us are surprised by what the rules do allow as long as there's a management level oversight from the client side of things. So as we move away from the AICPA's Code of Professional Conduct and into the Pennsylvania Institute's Code of Professional Conduct, you'll note on the slide some distinct similarities to the AICPA's rules. So we've spent a good 20 minutes here talking about how the AICPA approaches the Code of Professional Conduct and what each section is structured like. We can move through these next two slides in about a minute here by simply stating this. The PICPA has, with virtual identical applications application adopted the rules of the AICPA. So as you look through some of these areas, you'll see they're all the things that we've already talked about. They're generally structured in the same way. And in fact, if you went to the PICPA's Code of Professional Conduct, which is available on the PICPA's website, you would see that the language is pretty much the same as the AICPA. That was done with purpose and with intent to make sure that we didn't have to, at a state level, follow rules that differed greatly from the national rules that we all need to follow. So now that we've spent a fair amount of time talking about the AICPA and PICPA rules, we're just going to go at a very high level into some of the other rulemaking bodies. The purpose of this presentation is to give some direction on the rules that the CPA has to follow in conducting their business. And it's to open your eyes and expose you to a few of the other things you need to be considering. So the first is the PCAOB. The PCAOB is the Public Company Accounting Oversight Board. This is the organization that is charged with governing the audit function regarding public company audits. So they initially started with just the AICPA's rules when they first came out, used the independence, integrity, and objectivity framework of the AICPA, and then over the years adopted some much more restrictive rules in most cases. In some cases, they're just different, not necessarily more restricted, but gave a little more specifics regarding auditor independence, some tax services that are allowable or non-allowable, some specifics relative to the CPA's interaction with an audit committee, things that really are more particular and specific to the public markets. And if you serve in that area, whether it's auditing public companies or you serve on an audit committee of a public company, or you're just frankly curious about the rules we need to follow in that world, those are much more restrictive rules, but we are not going to get into the detail of going through each of them in this presentation. Many of you have heard the term Yellow Book or governmental auditing. The Yellow Book is the rules and the principles that guide governmental audit work in accordance with the GAO, the Governmental or the General Accounting Office. There's a lot of similarities between the AICPA's Code of Conduct and the GAO's ethical principles. To the extent that we're not going to go into a tremendous amount of discussion today, other than to say that there are some specific safeguards that are required to be in place. If you work with an organization or you work on organizations that are subject to GAO rules, those 7 rules, those 7 safeguards are things that you should know and be aware of. In many cases, they're similar to the concepts and the principles we've already talked about, but something that you ought to be aware of and go into the detail and take a look at. Finally, the Department of Labor, who somehow has distinguished themselves here as being the most restrictive rulemaking body when talking about independence and ethics. The Department of Labor has a significant amount of rules in place relative to the independence required between an auditor and let's say an employee benefit plan or a plan sponsor. So in an area where you may be on a client side, you're on the internal accounting side, and you're seeking to have potentially a new audit firm look at your employee benefit plans, or you're on the external side and you're looking at an employee benefit plan audit practice, you need to be aware that the Department of Labor's rules are far, far, far more restrictive than the AICPA's rules. And quite honestly, in many cases where a auditor would be perfectly acceptable to do the audit work of a client under the AICPA's rules, the Department of Labor rules may prohibit that relationship, not only for the current year, but also for the following year. So again, not something we're going to get into and spend a tremendous amount of time on today, but an area to be aware of if that's an area that you play. Okay. That concludes our discussion on the CPA's considerations relative to ethics and independence. I invite you again to use the chat feature if you have any questions coming out of that presentation, and lodge those questions. We'll have some time at the end of the presentation to address those that come through. And with that, I'll turn it over to you, Elaine, to talk through the IIA and ISACA ethics and independence rules.
Thank you, Mike, for your thorough discussion of professional ethics for certified public accountants. As you indicated, we're now going to discuss 2 other areas of the audit profession. That is internal audit and IT auditing. That is the key organizations that support those two areas are the Institute of Internal Auditors and the Information Systems Audit and Control Association. And of course, each one of those have certifications that they provide, and they have a code of ethics that are to be followed. With the Institute of Internal Auditors, the first segment is integrity. And the integrity of internal auditors establishes trust and provides the basis for reliance on their judgment. It requires that the internal auditors perform their work with honesty, diligence, and responsibility, and they observe the law and make disclosures expected by the law in the profession. An internal auditor should never knowingly be party to an illegal activity or engage in acts that are discreditable to the internal auditing profession or to their organization. An internal auditor is required to be objective. The auditor should exhibit the highest level of professional objectivity in gathering, evaluating, and communicating information about the activity or the process that they're examining. Internal auditors make a balanced assessment of all the relevant circumstances, and they should not be unduly influenced by their own interest or by others in forming their judgments. Again, the internal auditors should not participate in any activity or relationship that may impair or be presumed to impair their unbiased assessment. It's also, you should note that it's sometimes perceptions, even though you may be involved in an activity that is not does not impair your judgment, there may be a perception by others that your judgment is impaired, and so you should really be careful to avoid any kind of conflicts at all that may give others the opinion that you're not objective. Do not accept anything that may impair or be presumed to impair your professional judgment, such as gifts, etc. And auditors are required to disclose all material facts known to them that, if not disclosed, may distort the reporting of activities under review. And I know one area people get into where they have some difficulties at times is they're performing an internal audit, and the issue that they found is corrected before they're even completed with their field work. But in that case, you're still required to provide the information as part of your internal audit report, even if the management response is that the issue is resolved. The next section is confidentiality. Internal auditors should respect the right and ownership of information they receive and not disclose information without a proper authority, even unless there's a legal or professional obligation to do so. And that's not only outside of the organization, that can also be internal within your own organization as well. And an internal auditor should never use any information for personal gain or in any manner that would be contrary to the law or detrimental to the legitimate and ethical perspectives of the organization. Competency. Internal auditors are to apply the knowledge, skills, and experience needed to perform the internal audit services. And auditors should only engage in those activities for which they have the necessary skills, knowledge, and experience. And all internal audit services should be performed in accordance with the international standards for the professional practice of internal auditing. And internal auditors are required to continually improve their proficiency and effectiveness and quality of their services. And as you can see, this is very, very similar to what Mike covered with the AICPA. Okay. The next organization we're going to talk about is the Institute of Internal Auditors, is the Information Systems Audit and Control Associations, who also has their own code of ethics. And this code of ethics supports the implementation of and encourages compliance with appropriate standards and procedures for the effective governance and management of enterprise information systems and technology. They include audit, control, security, and risk management. The IT auditors are to perform their duties with objectivity, due diligence, and professional care in accordance with the professional standards. They are to serve the interest of the stakeholders in a lawful manner while maintaining high standards of conduct and character and not discrediting their profession or the association. Again, they need to maintain privacy and confidentiality of information obtained in the course of their activities unless disclosure is required by legal authority. And such information shall not be used for personal benefit or released to inappropriate parties. And I think it's beginning to sound like we're repeating things over and over again. So information systems auditors maintain competency in their respective fields and agree to undertake only those activities they can reasonably expect to complete, given their skills, knowledge, and competence. They are to inform appropriate parties of the results of the work, including disclosing all significant facts known to them. If not disclosed, those facts may distort the reporting of the results. Support the profession as far as the education of stakeholders in enhancing their understanding of the governance and management of enterprise information systems and technology. So in this area, there's a presumption that most of the individuals that you will be auditing are not as knowledgeable on enterprise information systems, and so there is a requirement to do an education of the stakeholders during the process. So what I've put together is really what we've come up with today is common professional ethical objectives. Honesty and integrity. And Spencer Johnson says, integrity is telling myself the truth, and honesty is telling the truth to other people. So one of the fastest ways for others to lose respect of you is to operate in a way that is do as I say, not as I do. So again, you need to operate with integrity. Transparency and confidentiality. According to Jerry Adams, one man's transparency is another's humiliation. And transparency includes a quality of openness and candor which helps people to understand why decisions are made. This must be balanced with confidentiality to protect valuable or sensitive information, which is disclosed, if disclosed, will harm the organization or be in violation of privacy laws. And the third component of most professional ethics is the competency and due diligence. According to Confucius, the expectations of life depend upon diligence. The mechanic that would perfect his work must first sharpen his tools. So not only should we as professionals maintain our competency and only engage in activities for which we are qualified, we should also perform our duties with due diligence. We should not jump to conclusions, but make sure we have sufficient evidence to support our assertions. Looking at the quote by Confucius, who wants a mechanic to work on their car if that mechanic does not know his trade and jumps to a conclusion about what is wrong with your car before taking due care to evaluate the root cause of the problem? And that's the same approach we need to take as auditors. So where we see that there's a common thread that goes through the professional ethics of auditing, there's also another dilemma that we're facing here in the workforce today, and that is generational differences. We're currently working in environments where it's not unusual to have 4 different generations represented in the workplace. Understanding the different ethical perspectives of the generations can assist us as members of an audit team or in understanding our auditees. And if you look at the different generations, we start with the traditionalists, the 63 to 86-year-old range. And they very much adhere to the rules. They have a dedicated work ethics. They value due process and fair play. They value honor. They value compliance. Go do things by the book. The baby boomers, the 44 to 62 age, we're the ones that challenge authority. We dislike conformity and rules. We value equality. We value personal fulfillment and gratification. We're willing to take risk, and we work efficiently. The Generation X, the 28 to 43-year-olds, like a casual work environment, look for meaningful work and innovation, move easily between jobs, and they're criticized for not having a particular attachment to a job or an employer. And then the millennials, the 8 to 27-year-olds, they want long-term relationships with their employers, but on their own terms. And they recognize that people make the company successful, and they understand the importance of great mentors. So if you look at the scale, you can see that we move from the traditionalists, who are very much compliance and do everything by the book, over to the millennials, where they like to do it their way. So the auditor has a challenge for the majority of the people in the workforce that they're dealing with now, because they were moving away from the generation that did everything by the book and were very compliance-oriented to a generation of people that are more independent and like to do things their own way. And then, therefore, the auditor really has a need to justify and explain the reasons, and that comes down to the professional code of ethics as well, because people don't necessarily just accept the fact that there's a professional code of ethics and that's what I should do. I should audit by the book according to that code of ethics. So again, we need to make sure that when we're working with our peers, when we're working with our auditees, that they understand the reasons behind our code of ethics and what we talked about, and why we need to be objective and independent in what we do, why we need to report everything that we find. So again, keep in mind the generational differences as you go through completing your audits and working on your audits. We have a few minutes left. I want to talk through a couple professional ethics dilemmas here. There's an expectation that accountants and auditors will apply their professional judgment in a way that supports the public's interest. Both accountants and auditors are well known as whistleblowers, but quite often we find ourselves in a moral dilemma where application of our professional judgment in support of the public's interest is at odds with our personal interest and the interest of the executives we work for. There are many examples where professionals made the choice on the side of their personal interest. One example is Sharon Watkins, who was a CPA at Enron. She was the VP of Corporate Development and had previously worked for Arthur Andersen. She did not blow the whistle in the interest of the greater public good. She simply wrote an anonymous internal memo to Chairman Kenneth Lay relaying the fact that there were financial misstatements, and she was concerned that there were whistleblowers within the company. So she only spoke up when she feared that she would be caught and implicated. So she did end up testifying and ultimately won the 2002 Time People of the Year award. But if she would have gone public sooner, do you think there would have been less harm to the public? So how do we, as auditors, handle these dilemmas and adequately apply our professional code of ethics? Another ethical dilemma is that of segregation of duties. If you think about the auditor who observes that a receivables clerk has physical access to and control of cash receipts, but the auditor is a good friend of the clerk and has a high level of trust in the individual, the auditor notes in the work papers that controls over receipts are adequate because of their personal judgment that the individual is a reliable and trustworthy individual. We not only have a segregation of duties issue that's not reported, we also have a professional ethical issue with the auditor. So the auditors must be alert to opportunities for fraud or conditions and activities where irregularities are most likely to occur, and they do need to take their personal bias, their personal opinion out of what they report and simply report the facts. And then we have the case of whistleblowing. During the course of an audit, the auditor learned that certain individuals in the organization were involved in dumping toxic waste in a nearby stream. The auditor has decided to report her findings to the appropriate individuals within the organization. So now the auditor has reported the facts, and they've reported it within the organization, but then the ethical dilemma becomes, is that sufficient? If the auditor knows that the individuals that they reported the information to within the organization did not do anything about it, does the auditor have an obligation to report that information to the legal authorities and report it outside of the organization? So again, some ethical dilemmas to think about, and again, in this particular case, if the auditor reports it outside the organization, they may be looking for another organization to work for. So it may be at odds with not only the organization, but with their personal interest as well. Okay. So we have gone through and we've looked at the similarities in the professional code of ethics, and I thank you for joining us today. Reed is going to do some wrap up here with a little bit of housekeeping items, and then we're going to give you an opportunity to ask some questions.
Very good. Thank you, Reed. We had two questions that were posed relative to the portion that I presented. The first question was related to the ability of an accountant or an accounting firm to prepare reconciliations on behalf of management if you're the audit provider. I would say the answer to that, in very brief sense, is under the AICPA rules, there is an opportunity for that relationship to happen. The AICPA rules have a few requirements. The first requirement is that the accounting firm cannot make operational or financial decisions on behalf of the client. Preparing reconciliations does not necessarily mean you're making operational or financial decisions. It means you're simply gathering and reporting data. So you are permitted in that case to go ahead and do the reconciliation under certain parameters. However, the decisions that would come out of the results of those reconciliations would be outside of what you're permitted to do. Other requirements are in place to let that happen. One is that the company or the client is required to designate a management level individual to oversee those services. So there has to be somebody who ensures that what's done is appropriate, what's done makes sense, and makes the final decisions on accepting the procedures that were performed. Other requirements and procedures. There needs to be an established engagement letter and engagement understanding between the two parties. Those need to be in place. And so under the AICPA rules, yes, in simple terms, that relationship can occur, but there do need to be some things put in place. And those are spelled out in the AICPA's Plain English Guide to Independence. That is something that when the final information subsequent to this webinar is sent out, that information will be provided to, the links to that information will be provided to you. The second question is relative to the new exposure draft. Some of you may have heard about. The AICPA has been working towards simplifying the independence and ethics language. There was an exposure draft issued. It's about 237 pages long. If you have a desire to go read that. The intent there is to take all of the data. The Code of Ethics we talked about today was issued in 1973 and has evolved and changed dramatically since then. There's a movement underway to ensure that we simplify things, make it easier to go find the information that you need. The new document, when it comes out, will be broken into multiple parts. Part one will be for public practice, so the CPAs who are on the public accounting side. Part two will be for those on the business side. So much of what we talked about today, where we were focusing a little more on the public accounting side, because that's really what the literature is geared towards right now. There will be an entire section devoted to how to interpret ethical decisions within business. And then the third part will be for they're defining as others. So it'll be retired folks or folks between jobs and how some of these ethical implications may affect them. So we didn't talk about it today simply because it's still in comment period. The comment period closes in August of this year. Those comments will then be assimilated by the Ethics Board, and a final code or revision is expected to come out in January of 2014, not effective until December of 2014. So I think on the horizon here, if you keep an eye on things, it gives us an opportunity to do another hour of ethics credits when that document comes out in 2014, so that we can explore some of the changes that have been put in place there and some of the clarity that's been put in place.
We have one follow-up question relative to the one that Mike answered on reconciliations, and that is, can an internal auditor perform the reconciliations? And again, doing the reconciliations is a control function. And so when an internal auditor performs the reconciliations, what you have is the internal auditor performing the control function. So whereas that is allowed and the internal auditor can do that, they would then not be able to audit that function for at least a year after they performed that work.
And I would just, as a final clarification on that, the SEC rules, to be clear, are different, and the SEC rules would be more restrictive. So if you're coming from a public company perspective, some of the things I talked about as being in place that would allow an auditor to perform those reconciliations would not be permitted in many cases under the SEC rules, even though it would be under the AICPA. So with that, there are no further questions showing up, so thank you all for joining us. We certainly appreciate the attentiveness and the interest in the topic.
We'd like to thank you once again for joining us for this presentation presented by McKonly Asbury, Certified Public Accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us online at www.macpas.com. Thank you again and have a great day.